Hey everyone, thanks for joining. Today I will be speaking with Jason Sheron. He's the owner and broker of Home Loans Inc. Thought for the day, what are the most effective ways that you can use a mortgage? And we're going to talk about a bunch of different terms. We're going to talk about things like PMI and break them down, kind of debunk some of the myths around them. And we're also going to talk about ways to transition your wealth using mortgages to your children to help them out in a more effective fashion than a simple cosign. So that's the thoughts. Break those things down, and the action is use some of the ones that apply to you to help grow that wealth. I'm not saying implement them all. They're not for everyone, but if you use them effectively, they can be great wealth generation tools. All right, Jason, thank you so much for joining us again.
I appreciate it. It's a lot of fun the first time. Yeah. Excited to be back.
Super. I wanted to, before we dive into this, I want to talk about, the best ways to leverage debt, specifically mortgages. Can you just kind of give people, who you are, tell me a little about your company as well, and help people understand why I would even want to have someone like you on the show?
Sure, absolutely. So my name is Jason Sheron. I'm the broker and owner of Home Loans Inc., which is a small little boutique mortgage brokerage here in Charleston, South Carolina. We've got 25 to 30 employees. Some of the things that I've been recognized, some of the places I've been recognized by recently, I was recently, picked up on Forbes.com for one of my 3 mortgage books that I've written. They interviewed me and published an article that I wrote on artificial intelligence in the mortgage industry. Second, I was featured a couple months ago by Yahoo Finance, and last year I was on the Money.com best lender list, and then a number of different mortgage-specific industry periodicals, Mortgage Professional America, that kind of stuff.
Awesome. So, I think your ability to understand not just mortgages, but how it blends into the general investment landscape as well is awesome. That's why I wanted to have you on to really talk about, okay, you've done one on this is the lay of the land mortgage-wise. Now I wanted to do kind of a follow-up focusing on, all right, I want to get my first mortgage. Whether I'm doing it by myself or my parents are helping me, how do what are some things I should think about as I'm getting this mortgage to truly make it like an effective mortgage? Let's start with, we were talking about it before, PMI. The thought about PMI, how much you're putting down, avoiding it, and just kind of thinking it all the way through. Just kind of give me your thought process on that.
Sure. So PMI 101 is private mortgage insurance, is money you pay every month that protects the lender in case you default. So everybody thinks, oh, this is a horrible thing, I don't want it. And true, it's money that you spend that doesn't afford you any protection whatsoever. However, it's very cheap insurance. And how I teach people to leverage that is what's the highest best use of your dollar, right? So you could have a larger down payment and have no PMI. But if you used a smaller down payment and had private mortgage insurance, would the money you saved from the down payment, could that produce more income for you than the cost of the PMI? And
when do you need to have PMI? Like, what's the threshold?
Sure. So the threshold is 20% down or 80% equity in the property on a refi. If you have 20% down or 80% equity on a refi, then you don't have private mortgage insurance. So if you went and purchased, a typical conventional minimum down payment is 5%. There are some 3% down options, but let's go with 5% because that's the most common. If you put out 5% on a $400,000 house, let's say it's $20,000, you're going to have PMI. If you've got decent credit, 700 or above, your PMI is probably be 0.25 to maybe 0.35% per year. So you're looking at PMI of $80 to $100 a month. So let's say instead of putting down 20%, so 20% of $400,000 is $80,000. You only put $20,000 down. Now you got $60,000 that you're not putting into the house. Mm-hmm. They can take that $60,000 and invest it with you, and I bet you with $60,000 you're going to make them more than $80 a month.
I can do better than 0.25.
So it's a no-brainer. I mean, what's the highest and best use of my dollar? Do I want to just give that money to a financial institution and have it? Sure, it's equity in your house. It's not like you're giving it away, but could you use that money and make a whole lot more out of it?
Right. Now, what about the counterpoint someone will make, which will be, well, it's going to be that 0.25, but then also the mortgage rate or whatever it is, let's just say it's 3% on top of that too. So it would be 3.25% that you've got to hurdle. And it's, compounding, interest and all that. Does that change your thought process on that at all?
No, I mean, so a 20% down mortgage and versus a 5% down mortgage might be an eighth of a percent difference. I would rarely see it be much different than that. If you got to where you're putting down 30 or 40%, you could see a significant change. You maybe a quarter to, to a half percent change in your mortgage. But if you're only, the difference between 5 and 20% on a primary residence is minimal. Now, the difference between, for an investment property, if you're buying an investment property, the difference between minimum down payment on that is 15%. 15% to 25%, there's a significant difference in interest rate. So if you're talking about investment properties, that's a different scenario. But primary residence, or you're trying to help your children buy a primary residence, there's minimal difference with that.
Gotcha. So I'm glad you brought up helping your children buy, because that was another area where you were talking about down payments, parents potentially helping, and then the growth of the actual asset itself and gifting. Take me through what that looks like in your world. You can use kind of a scenario or just talk in hypotheticals, whatever you think.
Sure. So just like you, I'm very passionate about helping my clients build wealth, right? I'm not a financial advisor. I kind of consider myself a debt advisor, right? How do you use debt? How do you leverage debt to make money? So let's say you have a primary residence. You've got some money to invest, and you want to help your adult children. Let's say they're just started college, or maybe they finished college and it's time for them to buy primary residence, and you want to help them out to help build their wealth. So you can gift them money, and gifting on a mortgage is completely different than IRS gifts. So there's no no cross contamination there. It's two different realms. But you gift them money. Let's say you gift them 5% for their down payment. So now they buy a $400,000 house, and say they qualify based on their income. You can co-sign, but that's a different discussion. You give them 20 grand. Now they invest that $20,000 into that house. They've got their payment. They're living there. They're gaining equity by making their payments. Maybe there's some PMI, but it's less than $100 a month generally. And that house is growing historically for the last decade or so. House have grown 5 to 10% per year. This year it's hit 18%. Mm-hmm. So you take that $20,000 and you're leveraging $40,000 worth of debt. I mean $400,000 worth of debt. So now that $400,000 house next year is worth $480,000 off of a $20,000 investment. Mm-hmm. Not to mention you pay down the principal a little bit, and then let's say you go leverage that and start buying investment properties. Let's say you put $50,000 into a $200,000 investment property. So now that you put $50,000 in, you bought a $200,000 investment property. You're making some rental income on it. You're getting some payment down on the principal, but then that $200,000 is worth $250,000 next year. So you've got $50,000 of equity growth on a $50,000 investment in 12 months.
Right.
And then after that, it's just, gravy.
Right. I like it too, because if you were to, and it's kind of fun having you here talking about real estate, and I can talk about the markets. When I see parents give to like a joint account with their children, they're both on joint, and anything that we make is taxable in the market. So and when you think through like where are the tax headwinds and where are the tax tailwinds, if I were to take that $20,000 and let's just say I made 20%, that's fine. There's no leverage in it, which is a different story too. We don't use leverage. It grows 20%. So now I've got my, $24,000 that's there, but that money is taxable. Typically, the income that comes in is going to be fully taxable, and there's going to be capital gains. Versus in your scenario, if that property grows, and they say they sell it. Let's just say that it was a student, because I see a lot of people. I'm from Los Angeles. So we would see a lot of students come in, go to UCLA, which is where I went, and their parents would buy them a condo. And they would let them sit in that condo because real estate in Los Angeles is always going up. They buy it their freshman year and they sell it their senior year. You have 4 years of appreciation. They would, I don't know whose name they would put it in, but you would usually get that tax break when you go, if the, $250,000 per owner. And, it would pay for their college. And I was always amazed. But I didn't hear about that until after I had left. I'd start to see like, oh, this is what people had done. And I look back, that's what people would do, the more wealthy families. So to your point, that'd be a way that you get a tax tailwind with an investment as opposed to a tax headwind if you're putting it directly into the markets and leveraging debt.
Yeah, you're 100% correct on that. Obviously we're delving more into a CPA type area, but the basics of capital gains for a home that you're selling is if you lived in the house for at least 2 of the last 5 years, then $250,000 or $500,000 if you're a married couple is not subject to capital gains.
Right.
So if you bought the house and you either you financed it with your child or you bought it and pay cash for it or whatever, it doesn't matter. The basis, say you bought it for $250 and in 4 years you sold it for $300, that's $50,000 and is well under. Let's say you just hit a home run and they lived in it for 4 years. And let's say they're working on a doctorate. Like I bought a condo 2 years ago in Auburn. My son's is in pre-veterinary medicine, so he's going to be there for 8 years. So that's going to grow for 8 years. So as long as he lived in it, he's on the deed, for at least 2 of the last 5 years, then the max growth that the minimum growth that I'll be taxed on is $250. So as long as and let's say it sold for I had $260, so I'm only paying tax on $10,000 worth of growth. I mean, it's a no-brainer.
Mm-hmm. I think it's those strategies to me, as people look to. I mean, a lot of times they get advice. People get advice in a vacuum. They'll talk to you and they'll talk through it, and they're like, "Oh, I got to come up with the money." But being able to have a conversation like this, where I can look at it and I can tell someone, sure, why not give your child $20,000? But to your point, what's the best use of that dollar? How are you going to actually make the most money with that investment? And if you have a child that's going to school, trying to buy their first place, it's like, real estate is an investment. I know you live in your investment, right?
Sure.
But it is an investment. It does go up, and I mean, especially if you live here in Charleston, it goes up. It's skyrocketing.
Yeah, it's ridiculous because the jobs market. But you do have to understand your exit. Just like you advise your clients on any investment, you have to understand your exit plan before you enter. Mm-hmm. So, like if you're buying a house if you're buying a house with your kids, you're going to put your kids on it. This is a mistake I've seen recently. A person bought a house and they put their kid on it because at their demise, they didn't want their kid to be worried about stuff. They wanted it to be their kid's house. Right. So let's say you buy a house, you put your kid on the deed, you're living in it, so it's not your kid's house, but it is technically because he's on the deed, and then you die 10 years later, and now it's the kid's house. He did not live in it for 2 of the last 5 years. Mm-hmm. So he's going to have capital gains tax. So let's say you live in the house for 10, 15, 20 years, that's a lot of growth that he could possibly be taxed on. So in that type of case, you would get with you're my friend Casey, and to get a trust set up and then have that house put in a trust. Right. So that way, whenever that you're at your demise, that the valuation for capital gains is the value of the house at your death, not whenever you put your son on the deed. Because whenever the son owns the house 10 years ago, that's his basis for the capital gains growth. So it really depends on the collateral that you're buying or the investment that you're putting money into and what your long-term plan is with it. Right.
No, I like we need a bigger table. I got this little stool, and we're going to need more people and more people kind of go through. We feel like we might need some graphics too, because when people look at it, these are real numbers that have real, like these significant returns for family members. I love the idea of using, thinking about PMI in a different way and really using the dollars and letting them grow. I love the idea of gifting the down payment to children because it does help them really kind of get started. I think so many people struggle with just getting into a home. And the idea that you have to throw down 20% to even get in, for a lot of parents, they're like, I can't put that much down. But if they could put down maybe a smaller amount and the child could actually, support the cash, payments, it does give them a chance to get into an investment. That investment can grow, and then if over time they outgrow it, say they start with a condo and they have a family that's too big, at least there's some growth there that will allow them to then roll up to the next house, which I think is very intelligent. Are there any other strategies that you kind of see best use of debt, at least through the mortgage world, that families should take advantage of?
So if someone has a lot of consumer debt, cars, credit cards, student loans, whatever, right now it's amazingly good time to cash out refinance on your property, get that, pay off that debt. Like right now I've got a loan from Mike and Michelle that will be closed next week that we're raising their interest rate. It's crazy. So they're at a lower rate today that I'm going to put them on their loan that we close next week. They're going up in rate, and they're going to pay off all this debt. They're going to save $1,800 a month in their consumer debt payments. Wow. I've coached them and given the numbers of, hey, I want you to you're already paying this $1,800 a month. You're on top of your mortgage payment. Their total payment's like $3,000 a month for all their debts. So I'm like, I want you to take that $3,000 a month and pay it towards the new mortgage payment. Mm-hmm. They're going to pay off their 8 years into this 30-year mortgage, so they get 22 years left. If they do what I tell them to do and keep paying that $3,000 a month towards this new 30-year mortgage, they're going to pay off this house in 9 years.
Wow. So
in 9 years, they're going to be debt-free, have a $400,000 house, which would be a lot more in 9 years. And I mean, their life's going to change by leveraging the debt in the smart manner.
I like it. And I think a lot of times you have to slow down enough, because I think, to your point, people would say like, the rate's higher, I'm automatically off.
Right.
But you got to look at the numbers. Like you're as that debt coach, you have to look at the numbers and say, well, here's all the debt that you have. Here's all those different pieces. It's almost like our Dave Ramsey course, if you will.
Sure.
And you look at the debt snowball, and you're like, what if we just put the whole snowball together and give you, maybe the rate looks higher, but the payment is going to make that snowball, like, it's really going to be impactful. Like, to your point, it's 22 years left on a 30-year, paying it off in less than half the time.
Yes.
And paying off all your other debt at the same time. You got to look at all the pictures. So how does somebody, let's just say I get 1 million views and everybody calls you, like, obviously you'll be overwhelmed. Like, how does somebody look at this on their own? They're like, where do they find these ideas, and how do they actually look at the numbers? Or is there a place that they can go to kind of digest some of these things, or a sheet online, or maybe they do just call you to kind of work through some of these things? Because it seems like this isn't like, it's not rocket science, but it does take someone that actually cares to walk them through the process.
Absolutely. So I don't think there's any particular resource that someone could go to and understand this. Just like someone, that's like the difference between trying to go to TD Ameritrade or one of the E-Trade places that you're paying, $5 a trade. I mean, what are you getting out of that, right? Sure, you're making good choices, you're making bad choices. You just don't have that expertise, right? So I don't handle the mortgage from the start to finish. There's no way I could. I'm going to close 300-400 loans this year. I just could not. If I tried to do that, I would be a horrible mortgage officer, and no one would ever call me back. I'd never get any past client referrals, right? So I've got a team of staff that are amazing. They work so much harder than me. I'm blessed to have them. I don't deserve them, but I have a team that handles the loan after the loan starts, right? So I'm the guy that structures it. I'm the guy that advises. I'm the guy that coaches. I'm the guy that says, I pull the credit and I say, hey, here's the numbers. I think this is a good idea. And I probably tell more people no on refinances than I tell yes. People come and say, hey, I want to refi, but I'm like, I said, I don't see any benefit here. I don't think you should. I'll do it for you. I'll make some money, but I don't think that's the right move for you. So I'm talking to everybody on the upfront. Now, once the loan starts, I don't know what's going on with it. Right today, I've got 67 active loans in my company, and I couldn't tell you anything about them, but I've got really talented staff that's going to give that white glove concierge service to get them to the closing table.
Right.
And that's how we have so many amazing reviews on Google and everything. But that first part, it takes a human, right? You can't replace that with AI or with a computer, at least not AI that's designed yet. It has to be somebody that's actually understanding you as a human, you as a family, what your financial goals are, what your financial situation is, what your debts are, what your understanding you, what your hobbies are, your wife, your kids, understanding you to give you the right advice.
Right. So let me flip it around a different way then, because I agree with you. There's no AI that's going to replace humans in crafting personalized solutions like this.
Right.
What questions should people ask when they start to kind of dive into really leveraging mortgages effectively?
Sure, it should be, hey, what are you doing with mortgages? Understanding the mortgage advisor, what's he doing with his money? I'm happy to tell people what I invest in. I'm happy to tell people about my properties that I have, and that so they understand, what my beliefs are. Because your money goes where your heart is.
Right.
So if someone understands where your money is, they understand where your heart is, and then if they know where your heart is, they know how you're going to advise them.
Right. I think that's great. Okay. Well, I love these strategies. I think that they're awesome, and I know if people have questions, they can obviously contact you, and you're a human and kind of walk them through all these things. But I mean, we've had you on a couple times, and I love your passion for mortgages. I love your passion for using debt effectively, and just appreciate having you on. I'm sure we'll have you on again.
Absolutely.
But thank you very much for sharing some of these strategies.
Honored to be here.
Yeah.
Thank you for listening to the Thought and Action Podcast. If you enjoyed this episode, don't forget to follow the podcast and leave a review. For more information on what's going on in the world of wealth, make sure to follow Family Fortune Financial on your favorite social media platforms. I look forward to you joining again soon.